There are a range of different portfolio evaluation measures that can be used, so it's important to identify which is the most appropriate under different circumstances. So of the different measures for evaluating a portfolio, which is most appropriate? Well, the answer is it depends on the assumptions of your investment, and it depends on the particular investment that you're actually evaluating. So first of all, if we think about the different portfolio evaluation techniques, the way that they differ is each of them have different measures of risk. In all of them, it's a trade-off between expected returns and risk, but risk is measured differently. So if the particular portfolio that an investor is seeking to evaluate comprises the entire investment for an individual, then that means that that asset is not going to be further diversified. Hence, we need to consider the total risk of that asset. Therefore, in that particular case where there's no further diversification, the most appropriate measure of risk is the standard deviation or the variance of returns. Hence, the Sharpe ratio or the M-squared measure are going to be the most appropriate tools for portfolio evaluation in that case. Where the asset that we are evaluating forms one part of a larger portfolio, that is, we're evaluating an asset that we're going to go and add as part of a portfolio, then we know that the asset we're evaluating is going to be diversified, so the unsystematic risk is going to be diversified away. Hence, in that case, we only want to look at the marginal risk that that asset will add to the overall portfolio. Hence, we want to measure risk as beta. So in that case, where the asset is part of a larger portfolio, we'll use one of the evaluation tools that use beta, either Jensen's alpha or the Traynor measure. Where we're evaluating an active portfolio, we want to trade off the benefits versus the detriments of active investment, and the one measure that does that is the information ratio. So we use the information ratio to evaluate the performance of an active manager. Or alternatively, if you're an investor who has a utility function whereby factors other than mean variance might be relevant in terms of your evaluation of returns, in particular if you're concerned with the high moments and skewness, then you might want to use downside measures of risk as supplements. So you might consider the Sortino ratio or the risk-adjusted return on capital. Important to note, though, that these measures are often used as supplements as opposed to standalone measures of portfolio evaluation. So now we've looked at different measures of evaluating portfolios, it's important to finish by thinking about some of the common portfolio evaluation mistakes. First of all, one common mistake is not to use theory. Okay, what people sometimes might do is just simply take a set of data, evaluate it, and assume that means that there is some strategy that's going to continue to work in the future. Okay, I can take just a random sample of stocks and find a random sample of stocks that, according to all portfolio evaluation measures, actually outperform the market, but that doesn't mean that same random sample is going to outperform in the future. One way that we can guard against that bias is by also having an investment philosophy that is grounded in theory. So we have the combination of both theory and past performance helping to drive our analysis. Another possibility potentially could be sampling bias. Okay, is that if we're evaluating our portfolio, we should use a relatively long time frame for doing so. If we use a short time frame, what we might find is that there was some specific event that dramatically affected our analysis. Other biases, as well as the small sample bias, can be survivorship bias. So what we often find is that we have firms that drop out of our portfolio. They might drop out because they become delisted. They might have, for example, gone out of business, or they might be subject to a takeover. In both those situations, often we find that there are extreme terminal returns for those particular stocks. So we need to be quite careful about not having a survivorship bias, that is, not only including those stocks that have survived across the entire sample period. Another potential mistake is failure to control for market performance. Okay, what we might find is that if we only look at the return of a portfolio, if we don't adjust for risk, then we might just be evaluating a particular portfolio in a period where the whole market did well, the whole market earned higher returns. In that particular case, just saying that your investment had higher returns doesn't really tell us much. So we need to focus on not just returns, but risk-adjusted returns. And last of all, we need to be careful not mistaking correlation for causation. Just because there's some relationship between two variables or two factors doesn't mean that a certain factor has caused higher returns. So overall, it's important to use a range of different tools to evaluate the performance of a portfolio and to feed that back into continuous improvement of your investment philosophy and your investment strategy.